For decades, global investing operated under a quiet assumption: geopolitics mattered, but only at margins. Wars were tragic but localized, politics was noisy but manageable, and markets ultimately reverted to fundamentals: growth, inflation, interest rates, and central bank credibility. That assumption is now obsolete. What we are witnessing is not a temporary disruption but a structural transformation in how power, capital, and risk interact. Geopolitics has moved from the background of financial decision making to its center. Investors across the world are scrambling to adapt to a system that no longer behaves according to the 20th century rules. Until recently, geopolitical risk was treated as a low-frequency variable. Portfolio managers might adjust exposure slightly during elections or regional conflicts, but the dominant belief was that globalization smoothed over political shocks. Supply chains were optimized for efficiency, trade was assumed to expand incrementally, and the global financial system rested on a relatively predictable American-led order. Markets priced economic cycles, not civilizational friction. That framework collapsed the moment geopolitical events began to impose direct and persistent cost on capital flows, commodity prices, currencies, and corporate viability. The turning point was not subtle. Russia's invasion of Ukraine in 2022 did more than trigger a war. It shattered the illusion that geopolitics could be compartmentalized. Energy markets were fractured overnight. Sanctions froze hundreds of billions of dollars. Shipping routes were re-evaluated. Defense spending surged across continents. Inflation spiked not because of demand but because politics had interrupted supply. Investors learned in real time that tanks and missiles could move beyond yields and equity indices just as forcefully as central bank statements. From that moment onward, geopolitical risk ceased to be theoretical. It became quantifiable, persistent, and contagious. One conflict spilled into food prices, another altered insurance premiums, a diplomatic breakdown translated into tariffs, export controls, and investment bans. The global economy stopped behaving like a neutral marketplace and began behaving like a battlefield of competing state interests. Capital could no longer assume safe passage across borders. It had to negotiate power. What followed was not a return to stability, but an escalation. Trade wars, once viewed as negotiating tactics, hardened into policy doctrine. Tariffs were no longer temporary leverage, but structural instruments of statecraft. Strategy industries, semiconductors. Strategic industries, semiconductors, energy, defense, AI, rare earth were explicitly weaponized. Governments stopped pretending to be neutral referees and openly picked winners and losers. For investors, this meant that valuation models built purely on cash flows and growth projections became dangerously incomplete. This is why demand for geopolitical analysis had surged across asset management, private equity, and sovereign wealth funds and corporate boardrooms. Investors are not suddenly interested in history or diplomacy for intellectual reasons. They are interested because political decisions now determine market access, cost structure, regulatory survival, and even price security of assets. A factory is no longer just a factory, it is a geopolitical asset. A shipping route is no longer logistics, it is a strategic vulnerability. A currency is no longer just a medium of exchange, it is a sanctionable instrument of power. One of the most revealing shifts described in this video will be psychological rather than technical. The inversion of base case thinking. Traditionally, investors constructed a base case of stability, an upside scenario of growth and a downside scenario of crisis. Today, many institutions are reversing that hierarchy. Worst case scenarios are being treated as baseline assumptions. Stability is no longer assumed to be justified. This reflects a sober recognition that shocks no longer are rare events, but recurring features of the system. Corporate boards have absorbed this lesson faster than the public realizes. Executives now understand that political decisions can erase your years of strategic planning in a single announcement. Export bans can strand inventory. Sanctions can destroy partnerships. Elections can rewrite regulatory frameworks overnight. As a result, geopolitical briefings, once reserved for diplomats, are now routine in boardrooms. CEOs are expected to understand not just markets but motives, alliances, and fault lines. Banks and consultancies have responded accordingly, not out of foresight but necessity. Dedicated geopolitical units are being built because clients are demanding answers that traditional financial analysts cannot provide. Investors are asking questions that would have seemed unusual a decade ago: which countries are likely to fragment internally, which leaders are incentivized to escalate rather than compromise, which alliances are transactional rather than durable, which conflicts are contained and which are designed to spill over. These are not abstract questions. These directly affect asset pricing. When investors assess exposure to energy, they must evaluate not only supply and demand, but the probability of blockades, sanctions, or sabotage. When they assess technology companies, they must model regulatory retaliation, data sovereignty laws, and export controls. When they evaluate emerging markets, they must consider not only growth potential, but regime durability, alignment with major powers, and especially telling detail in the article in this renewed investor interest in politically unstable regions such as Venezuela. This doesn't select recklessness, it selects adaptation. Capital doesn't retreat from chaos, it studies it. Investors want to understand who controls what, how power is distributed, and where asymmetries exist. In unstable environments, returns are not generated by optimism or by informal advantage. Those who understand the political terrain move first, while others hesitate. This is the deeper transformation underway. Markets are becoming arenas of political competition rather than neutral allocation mechanisms. Capital is flowing not to where conditions are most efficient, but to where influence can be secured. Safety no longer defined by distance from conflict, but by proximity to decision makers. Investors are no longer just analysts, they are strategists navigating an increasingly fragmented world. Volatility in this environment is a temporary spike. It is structural. Rapid policy shifts, personalized leadership styles, and weakened multilateral institutions ensure that uncertainty persists. There is no stable equilibrium to return to instead. Markets oscillate between episodes of calm and sudden disruption, driven by announcement, elections, and escalations rather than earnings report alone. For individual investors and observers, the implication is uncomfortable but clear. The language of markets is changing. Understanding balance sheet is no longer sufficient. Understanding power, who has it, how they use it, and when they are likely to act, has become essential. Geopolitics is no longer commentary layered on top of economics. It is infrastructure. It shapes the flow of capital just as decisively as interest rates once did. In conclusion, what I am describing is not a trend. It is documenting a regime change. The era in which geopolitics could be safely ignored by markets is over. We are entering a period where geopolitical risks is not an external shock but a permanent condition. Investors who adopt by integrating geopolitical analysis into decision making may find opportunity and instability. Those who cling to outdated assumptions will discover repeatedly that the world no longer behaves the way their models expect it to behave.